Hey everyone, it's Wolfgang. This is about the stock market and the stuck housing market. Basically, if you're trying to figure out what to invest in, stay tuned. There's some important details about both of these markets that will help you decide which one is the best place to invest in. So what's the best choice to invest your money? So let's look at the stock market first, okay? Stock market is up, the S&P 500, at record levels. Over the past 12 months, not year to date, the past 12 months, we're up 12.1% on the S&P 500. 12.1%, pretty darn good, considering the backdrop of everything that's been going on with, the uncertainty in the world because of wars and conflicts. A new government came in, lots of uncertainty in the job market, but we're still up 12.1% over the past 12 months. Really good. The QQQ, which is the Tech 100, which I have been investing in for a very long time and done very well. It's the top 100 stocks in the NASDAQ, and a lot of those are technology stocks. I have a technology background. I was a software engineer for quite a while. I still write code when I feel like it. And the QQQ is an exchange-traded fund. It's up 13.2%, again, in the past 12 months. So it has done better than the S&P 500. So you can sort of understand why technology, those stocks might be doing well because of growth in technology. The main reason for investing in technology is because of growth. Technology is always changing. When it changes, the new things in tech usually grow versus the older parts of the economy. Like some parts of the industrial economy have gone offshore, but tech is still growing and it renews itself repeatedly, continuously renewing itself. 13.2% better than the S&P 500. So even the Russell 2000 small cap stocks are doing pretty good, comparison wise to what they've done in the past, but nowhere near 13.2%. And nowhere near 12.1% for the S&P 500. If you're a really security-minded investor, you really can't beat 12.1% S&P 500 ETF. An S&P 500 exchange-traded fund returning 12.1%, darn good, right? So here's the best segments in the stock market, okay? Financial services are up 30%, overall. 30%, the financial services industry has done quite well over the past 12 months. Aerospace and defense stocks, there's been investment there. Technology stocks, I've already mentioned. So those are the three hot places to put money. We're trying to figure out where should we invest, the stock market or the housing market. And you think you might know the answer to that question, but stay tuned because there's a surprise ending here, okay? So some of the stock market events that have caused problems and volatility. The first one, a big one, was when DeepSeek was announced. It was seen as an artificial intelligence competitor. It really dropped the AI stocks in the U.S. stock market. DeepSeek out of China caused a lot of volatility in stocks. That was a great time to buy those stocks. Great time to buy them because they dropped. Another problem with the stock market has been caused by the Buffett indicator. If you don't know what that is, please look that up. It's a historical look at levels in stocks over time that's attributed to Warren Buffett. The Buffett indicator has been saying for a while, stocks are overvalued, right? But we're up 12.1%, and we're up 13.2% on the QQQ. Okay, so volatility, besides DeepSeek and the Buffett indicator saying stocks are overvalued, geopolitical chaos has been hurting people's confidence. It's affecting Europe because Europe is trying to figure out if they need to switch parts of their economy to military spending, and in fact, they've decided to. They've increased their funding of NATO up to 5% of their GDP. Whether they're going to arm for conflict, arm their, sort of reposition their economy to go to war, possibly with Russia to defend Europe, remains to be seen. So that's really hurting people's confidence, definitely in Europe, but also in here because markets are international. We don't have a market that's confined to the U.S. With a couple of exceptions. Most markets are international. So when Europe is sort of under pressure, the U.S. markets feel that. So geopolitical chaos has been causing problems for people's confidence. April 2nd, this was another incident that hurt stock markets. April 2nd, Liberation Day, the market dropped, right? Tariffs were seen as a threat to economic to the economy generally. I mean, the expectation was, okay, Liberation Day, we're going to have tariffs. That's going to hurt the economy. Prices will go up. People's budgets will be crushed. And so the market dropped. So the market drop of DeepSeek, the Buffett indicator has been telling people to sell stocks. Geopolitical chaos has been hurting people's confidence. Gold has been doing quite well because of that. Gold has been on a tear because of this reason. People are concerned. Another thing I didn't list here is the downgrading of U.S. debt by one of the rating agencies. That also affected people's confidence in stocks. Gold also shot up for that reason, increased. Liberation Day, when the tariffs were announced, sort of tanked the market. And then after that, the tariff up and down roller coaster of, we're going to put these tariffs on this country, and then we're going to pause them. But no, we're going to restart them, but no, we're going to pause it. Sort of a back and forth roller coaster. Again, that hurt confidence of market participants. So what do you buy when you feel less confident? Gold and bonds, treasury bonds. So that's kind of the background of the stock market right now. But overall, I can't help but point out, if you own the QQQ, you've done quite well. And the S&P 500, a very conservative, an ETF play in the stock market, very, very good, 12.1% return. Try to get that at any bank, right? That's like 3 times what you can get at a bank right now for a CD rate. A CD rates are like 4%, 12.1%, really good. Okay, so let's switch gears. Let's look at the stuck housing market. It's stuck because the housing market is sort of, I call it deceased. I don't say it's a dead market. I say it's deceased. It's down, and it doesn't look like it's coming back anytime soon. It's down hard, okay? But there's a silver lining here. There's a surprise ending to this, and I will explain what I mean here in just a couple seconds here. So the main problem with the housing market is Powell is keeping rates too high. Okay, so briefly, I want to tell you the mistake that Jerome Powell and the Fed are making. Number one, Jerome Powell is not an economist. He's a lawyer. As to why he was put in that position is questionable. I realize that the current president put him in that position. He had an investment banking background. I guess the sense was he's going to look past his pure law background. He's got investment banking experience. Surely that means he's also an economist, right? No. Okay. Powell is not an economist. Okay. Because there are 2 kinds of inflation. The kind of inflation we all know about is when there's so much money and good times in the economy, people are buying, they're spending money. It's called too much money chasing too few goods. When everyone is feeling good and spending money, discretionary spending, buying TVs, going on vacations and stuff, that tends to push up prices of everything. That's called demand pull inflation. There's 2 types of inflation that Powell seems to be unaware of. He's not an economist. Okay, demand pull inflation means everyone has money to spend and they're spending it and prices are going up. So the way you fix that, that's demand pull inflation, you raise interest rates, okay? So Powell already did that starting in October of 2022. He raised interest rates dramatically. He completely tamed demand pull inflation. People stopped feeling flush with cash. They stopped their spending. They reduced their spending. So Powell has already fixed the demand pull inflation, okay? Demand pull inflation, too much money chasing too few goods. We don't have that problem right now. It's just the opposite. People are scared. They're not spending. So demand pull inflation has been tamed successfully by Powell starting in October 22. Okay, the second type of inflation is called cost push inflation. And that's what Powell is using high interest rates for, and you're not supposed to. Cost push inflation is when producers raise prices because they want to. So, for example, if all the car manufacturers decided we're going to raise prices 20% across the board, and they all did that, that would not be demand pull inflation. It would not be caused by too many people buying cars. It would be caused by the greed of the companies wanting to profit, wanting to increase their profits. Okay, so another way to create cost push inflation is if tariffs are enacted. When tariffs are enacted, companies say to themselves, we've got to pay these tariffs. In order to protect our profit margin, we're going to have to raise prices. So Powell is saying to himself, oh, price increases, I've got to fight that with high interest rates. No, you cannot fight cost push inflation like that with high interest rates. You can only, and look this up, people. I mean, look it up online if you don't believe me. Cost push inflation is not tamed by high interest rates. Powell is incompetent. He's an attorney. Someone should pull him aside and say, economists know that you can only use high interest rates to tame demand pull inflation. Powell did that in 2022. He's using high interest rates to try to tame something that will not work. Cost push inflation, companies raising prices to protect their profit margins, is not tamed by high interest rates. Okay, so the fault is on Jerome Powell for that, and that's why there are so many people who want this guy out of there. When someone is incompetent, you have to get rid of them. It doesn't matter if they're in government or in a company. If you identify someone as using the wrong tool at the wrong time, even an auto mechanic in a shop, you've got to scrutinize that. You've got to look at that and say, what in the heck are they doing, right? It's the wrong tool. So rates should be lower. That's why the housing market is stuck. He's keeping rate. He just said it the other day. He said, if it were not for the tariffs, I would be lowering rates. You should not be raising rates for tariffs because that's not demand pull inflation. High interest rates only tame demand pull inflation. Okay, I'll get off the soapbox now. So Powell is keeping rates too high. People cannot qualify for a mortgage. A lot of people are being prevented from buying a home because the rates are so high, they just don't qualify. And then some people are too uncertain to buy. There's a lot of uncertainty in the market. All the stuff that I previously mentioned in the job market too is a big factor. So some people cannot qualify for a mortgage. There's a bunch of other people who are too uncertain about a lot of different things we're confronting right now to buy. So the housing market is not doing too well. Home prices are only up 0.6% in the past 12 months. Compare that. 12.1%. The stock market, 0.6. That's less than 1% in the same time period. So why would I say this is a good idea? Because it's actually a good idea to own both, okay? Because, and by the way, Redfin pointed out that there are 500,000 more homes for sale than there are buyers. There's too much housing inventory. Anytime you read something nowadays that says we don't have enough homes, baloney. Look this up online. Redfin, 500,000 more homes than buyers. Look, that article is online. It's still up. I just checked it. There's plenty of supply of housing. People can't qualify, and some don't want to buy. Okay, so housing is only up 0.6%. Stocks are up 12.1%. The question posed at the beginning was, what's the best choice to put your money? Both, okay? Because these are uncorrelated assets. They're not behaving the same. Stocks are up 12.1%. Housing is up much less. But the volatility in housing is very, very low. The volatility in stocks is very high. I went over some of the reasons. The ratings downgrade, DeepSeek, the Buffett indicator making people want to sell, the geopolitical chaos, hurting confidence, Liberation Day, the tariff roller coaster. Stocks have been very volatile. And if you study finance, they equate volatility to risk. If you take formal training in finance and in investing and economics, volatility is associated with risk. So the highly volatile stock market, and it has been very volatile, up and down, scaring the heck out of some people. It's been very volatile. So people would say that's a very risky market. It's going all over the place. Housing has been very stable. So if you've thought about selling your property because the housing market sucks, that's the wrong answer. The right answer is to have as many uncorrelated assets in your portfolio as you can. Because at some point, markets go up, markets go down. Housing is going to recover. Right? It always happens that way. And housing will recover and stocks will have a period of not doing too well. That will come too. We all know that. So if you look up Ray Dalio, Bridgewater Capital, it's a big hedge fund. Ray Dalio, the last name spelled D-A-L-I-O. He covers this in depth, having as many uncorrelated assets as you can in your portfolio for a lot of different reasons. But you can consult Ray Dalio for that. But you want to have... You don't want to have one type of asset in your portfolio because when stocks have a correction, fall back, it's quite possible that one of your uncorrelated assets will be going in the opposite direction. Sort of like what we have now, because stocks have done quite well. Housing is in the tank. They're going in the opposite direction in terms of good outcomes. So the surprise ending was, even though the stuck housing market looks pretty sad these days, you actually want to hold on to your property assets. This is not a time to sell. This is probably the worst time to sell if you own anything related to housing, because buy low, sell high. When housing is only up 0.6%, there are a lot of sellers. They're depressed. They're selling, right? That's when you want to buy. That's the way you make money. When people are selling, you want to buy, right? Okay, so I think that for portfolio diversification, owning housing and owning stocks is a good idea to diversify. Just want to say something about yesterday. The big, beautiful bill was signed into law. Just want to just briefly describe what the impacts of that are going to be, most likely. So there's tax cuts in there. There are a lot of tax cuts that will affect consumers. So consumers will stop feeling scared about spending money. They'll start spending money again. Consumers will start spending money on discretionary things they don't need. New televisions, new cars, clothing, vacations, furniture, etc. So these tax cuts, it's the same thing that happened when the current president was in office the last time. The Tax Cuts and Jobs Act, I think it was 2016 or 17, really boosted the economy. Everyone was spending like mad. Everyone felt pretty darn good about their economic situation. They were spending. So the tax cuts will boost consumer spending. That will increase profits of companies, earnings of companies. When earnings of companies go up, their stocks go up because stock prices are based on earnings. So the tax cuts in this big, beautiful bill are going to help stock prices going forward. So the winners from this big, beautiful bill, consumer discretionary stocks like Amazon and retailers, defense industry stocks, because there's something in the bill, $150 billion boost in military spending, and computer chips. There's a big emphasis on stimulating computer chip manufacture in the U.S. will benefit from this, the big, beautiful bill. The losers, from the signing of this law yesterday, clean energy, solar and wind stocks are not going to do well, and electric vehicles, because they got rid of they're phasing out the subsidies for electric vehicles. That might be the reason Elon Musk is unhappy these days. So if you took the advice of people who advised getting out of stocks, that would include Warren Buffett. He sold $127 billion of stocks recently. Robert Kiyosaki also said get out of stocks. Harry Dent, a pretty famous naysayer for the economy, also said sell stocks. That would have been a huge mistake. We're up 12.1%, the S&P 500. The QQQ is up 13.2%. If you have any questions about this, I'd be more than happy to answer any questions if you post in the comments. And I really want to thank everyone for watching, and have a great day.